My take is that this is kind of normal, right? I mean, 5% pullbacks happen about 3 times a year. We haven't had one since Q1. Yeah, so in a way, it feels bad because volatility has been so low, but this is essentially normal. I mean, I think the good news is the valuations of the S&P are now closing in on long-term average levels where they were very elevated heading into this year and you know, in just a couple of weeks ago. So I'm more bullish today than I was a couple of weeks ago, and I was bullish a couple of weeks ago. I think the things we want to focus on are earnings, which are still healthy in the U.S. Valuations have come down quite aggressively. Positioning is probably washed out at this point. I mean, I think what's interesting about the sell-off over the last few days is that credit has remained remarkably calm, despite this big move in the VIX, despite this big move in the market. So, you know, I guess if we start to see rates stabilize, if we see credit not necessarily imply that this is contagious, I think those are all positive signs for equities.
You know, watching some of the sectors, we did see a big takedown in the technology sector yesterday broadly. S&P technology sector had its worst day in 7 years.
Absolutely.
Is that also a place where you say, okay, pile in, or is it different if you go sector by sector?
I think selectively. So tech, I think, was the most crowded sector in the S&P 500. I mean, it was, you know, a 30% overweight by the average fund manager.
So you think it deserved?
Part of that was just a positioning, you know, a risk that is now has been removed to some extent. I think within tech, you want to buy cash-rich tech companies, and you want to sell some of the more growthy, credit-sensitive areas of the market. I mean, I think the rule that we want to pay attention to over the next 12 to 24 months is that cash yields are rising, so cash all of a sudden becomes more important, and leverage becomes more evil. So anything with credit sensitivity, I would avoid, and I would buy cash-rich, large, healthier companies.
What about the financials? We're about to start hearing from the big banks as we get into the earnings season. And normally you would think if we're talking about higher interest rates, that's great news for the banks.
Yeah.
Is that the case?
I do think so. I think that financials could be the new high-quality sector going forward. Leverage ratios for financials are now 1/7 of where they were at the peak of the crisis. I mean, financials has totally cleaned up its act. So I see it as a beneficiary of better economic growth, a little bit of inflation, a beneficiary of rising interest rates as long as they don't rise too quickly. And I also think that balance sheets are not as much of a concern today as they were, you know, back in 07, 08.